This is Professor Aruja with an overview of the final exam for Accounting 104. The final exam review sheet is provided simply to give you an overview of everything that we've covered in the course. As you see here, the review sheet has chapters and learning objectives that are listed. The purpose of the final exam, which is only 66 questions long through 11 chapters, is just to make sure you have a solid understanding of the basic concepts that we needed to teach in this course. And so the final exam has nothing new on it. So there's no new information on the final exam. Everything that you have, that you will see on the final exam, you have already seen on other exams and quizzes and so forth that you've taken through the course. So the idea behind the final is really to assess the basic concepts and your understanding of those now that the course is completed. What you should do to prepare for the final exam is to make sure you understand the basic and main points of each of the learning objectives. So in chapter 1, the 3 primary forms of business are relatively important basic information to know. The principal activities for businesses, learning objective 2, is also a very important thing. So there's financing and investing activities and operating activities. The financial statements, the most important ones, as you know, the income statement is always the first one that's completed. It shows whether you have a profit or not for that period of time. The retained earnings statement is done next. It covers the same period of time. And it tells us how much of the profit is being retained in the company and how much of it had been shared with the owners in the form of a dividend. And then, of course, the balance sheet. And so, again, the main parts of the balance sheet: assets, the resources that the company has, the liabilities, where it borrowed money to buy those resources, and stockholders' equity, how much the owners have either paid into the company or the owners' profits have stayed in the company to purchase those assets. And so those are, basically what you should be doing for each of the chapters, is looking at the main objectives and making sure you understand the basics of each. Okay. Chapter 2, again, the classified balance sheet is the biggest part of chapter 2. That should take up most of your time to review the 4 parts, or how we classify assets into 4 different parts. And then, of course, liabilities are only broken into 2 parts, and nothing changes with stockholders' equity. Chapters 3 and 4 were basically the entire accounting cycle for bookkeeping. And so you learned how to analyze transactions. You learned about the accounts. You learned that there's a debit side and a credit side to every single account, just like on a coin. There's always a heads and a tail. All accounts are set up the same, except that, as you found out in chapter 3, that one side of the account has a different effect than the other side of the account. So for assets, the left side, or the debit side, increases the amount of assets we have. But that means that the credit side of the asset account decreases it. Liabilities and stockholders' equity accounts have the opposite effect, right? The right side, or the credit side, shows we have more liabilities or more equity. Thus, the debit side, the left side of the account, is how we decrease it. You had to use the journal. That's the first place accounting happens. Everything that we do in business requires a journal entry if it has a financial effect on the company. And so the journal is an extremely important part of understanding the accounting cycle. Everything starts in the journal. Whatever we put into the journal will be posted into the ledger. And the ledger is a very large book, well, it used to be, now it's electronic, but it used to be a very large book of accounts, and it shows us everything that happened in each of the accounts. And of course, how we know what happened to the accounts has come from the journal. So whatever happens in the journal gets transferred or posted into the ledger. The ledger shows us what the balances are in every single account that a company has. We have to make sure that the ledger itself is balanced. In other words, the debit balances in the ledger equal the credit balances in the ledger. And so you did a trial balance. And so the trial balance simply is to make sure that the ledger is balanced. Okay. In chapter 4, we went ahead and showed you how to close out the year for a company, close out a period of time. The important part of this closure is to make sure all the revenue and all the expenses are recorded for that period of time. The most common period of time we have to do the adjusting entries for is the year, because at the end of every year, we must technically close the books. In other words, complete the financial records for 1 year and start fresh with new records for the next year. And we keep those records separate year to year to year. And so in order to keep those records separate, we have to go through a closing process. Before we can actually close those books and do the closing process, we have to make sure we do adjusting entries. The purpose of adjusting entries is to make sure all the revenue is accounted for in that period of time, and all the expenses are accounting for in that period of time. In other words, we double check to make sure we didn't miss anything. The financial statement that's most important to focus on is the income statement. And so all the revenue is checked and all the expenses are checked. Because as you know, the income statement is the very, very first statement that's done in the process of creating financial statements. Income statement is always first. So if the income statement is wrong, that's going to flow over into the retained earnings statement and flow onto your balance sheet. So in other words, all your financial statements are going to be messed up. And so it's super important to focus on making sure all the revenue and expenses are accounted for. And so chapter 4 explains the adjusting entries. All the adjusting entries, as you noticed, affect either a revenue account or an expense account. That's done on purpose because those are the most important accounts to make sure we have right when we close our books. Everything flows from the income statement. Then, of course, once we have done our adjusting entries and updated, of course, all those adjusting entries are going to the journal. And you know what happens as soon as you put something in the journal, it flows over or gets posted to the ledger. So now we have some ledger accounts that have been affected. In other words, their balances have changed because we've adjusted them. So we have to make sure that now that we've changed those, the ledger is still balanced. And so we do an adjusted trial balance after we do the adjustments. Once the adjusted trial balance balances, well, we have our final numbers. We're ready to do our financial statements for the year. And so we go ahead and do our financial statements. The income statement is done first, as you know. The retained earnings statement is done next, and then our balance sheet is done last. And so once we have completed that for the year, we have to prepare what we call closing entries, because the following period of time, and whether you use a calendar year, January 1st to December 31st, or use a fiscal year, any 12-month period of time for accounting purposes, you have to keep those records, those yearly records, separate from each other. In order to make sure they're separate, we do something called a closing entry. Closing entries only affect 3 different types of accounts. The revenue accounts are closed. And when we say closed, we simply mean bring the balance to 0. The expense accounts are closed next. And again, closing expense accounts simply means bringing those balances to 0. Now, the differences between those accounts are moved into retained earnings. Why? Well, because on the income statement, revenue minus expenses gives you net income. And net income then is added to the retained earnings statement. In other words, the retained earnings account. So we increase retained earnings with the profits of the company. And the last thing we do on a closing entry, as you probably remembered, is we have to close the dividends account, because the dividends account simply tells us how much of that profit has been shared with the owners in the form of a dividend. In other words, it's going outside of the corporation itself. And so it's subtracted away from retained earnings. And so we have to make sure the dividends are removed from the retained earnings balance. So that basically is the purpose of closing entries. And after that, we start the very next day with zero balances in our revenue, our expense, and our dividend accounts, so we can start new records for the new year, be it a calendar year for some businesses or a fiscal year, which is any 12-month period that you can use for accounting purposes. And that basically closed the accounting cycle out in chapters 3 and 4. Now, because half of the class was dedicated literally to the first 4 chapters of this book, half the final exam is also dedicated to the first 4 chapters of this book. So when you do get to the final exam, you will notice that about half of the questions are from these first 4 chapters. Okay. Once chapter 4 is completed, we moved into basically more specific topics within accounting. And so basically chapter 5 and chapter 6 are done together because they both deal with inventory. Inventory is an asset account, it's a current asset, because the purpose of inventory for businesses that purchase it is to sell it. Retail, the whole purpose of retail is to resell whatever they buy. So they have to buy the stuff first, put it in the store. You go in and they want to sell it to you. And so the whole process is based around inventory. Inventory is extremely important concept. And for folks that are really good at inventory, they're making some pretty good money because we have a global supply chain. And understanding all of that is complex. And so they're paid quite well to do a good job, making sure those costs are low and making sure that there's enough margin or markup on the products to keep the company profitable. So chapters 5 and chapter 6 dealt with everything regarding inventory, and that should be reviewed. We did chapter 7, 8, and 9 in the 5th module, and these were very specific. Chapter 7 actually dealt with cash, although we really didn't deal much with cash because we focused significantly on fraud and internal control. It's in the cash account because it's the most susceptible to fraud. And so that was very, very important for you to understand, because this is, of course, a huge, huge issue. It's much more important to understand this than to, in essence, do a bank reconciliation, which is also part of chapter 7, what we didn't need to do. That's going to be done by bookkeepers. And if you're studying or want to do more bookkeeping type of stuff, you will learn to do that. But for the purposes of this course, which is a transfer course for all business students and not specifically accountants, it's important that the most vital portions of each chapter are discussed. And there's nothing more important in chapter 7 than fraud and internal control. So please make sure you review that. Chapter 8 dealt specifically about receivables. Most of chapter 8 was about accounts receivable. And then there was a portion of chapter 8 that talked to you about notes receivable. Okay. Chapter 9 was really about the long-term assets, your property, plant, and equipment, and your intangible assets were dealt with in Chapter 9. And so very important to sort of understand how that's broken down. Again, if you notice, 7 is about cash, 8, receivables. Chapters 5 and 6 was inventory, so those are current assets. Chapter 9 is your long-term assets, your property, plant, equipment, and your intangible assets. Chapter 10 and 11 dealt with the other side of the balance sheet, liabilities, and stockholders' equity, which you're finishing up here. So those 7 chapters went by relatively quickly because there's significantly less bookkeeping to do, as you noticed, but a lot more analysis. And so the focus on those chapters was to understand the accounts in more detail and to introduce you to more detailed financial analysis. And so there will be some financial analysis questions that are part of the final exam based on those chapters that you did. The review sheet also reminds you that there will be some calculations on the final exam, although it's really not meant to be stressful. It's meant to be a review. But make sure that you know how to calculate and remember how to calculate those things that are listed here on the sheet, because you will see them on the exam. I hope that this review was able to give you at least some confidence going into the final exam. Again, good news is there's no new material. It's all review. And half the exam is on the first 4 chapters. The other half is on the last 7 chapters that we did. And you're prepared. You are well prepared. The exams that I gave you in each of the modules are, in my view, tougher than the final exam. And so I think you're well prepared going into this. Just make sure you review that, you understand all of that before you start. You should be in very good shape. You do have to use it in one sitting, do the exam in one sitting. You do have 3 hours to take the exam. So make sure you have your materials and that you're in a comfortable spot, it's quiet, and I wish you the best.